and really particularly on behalf of the goals of our developing countries, I remain optimistic.
Thank you, Scott. Back to the national team, Clement, because just now I think we covered a lot in terms of trade, tariffs, and also the need to really stay cooperative in this potentially challenging era. But that said, I'm sure you can share with us from your own point of view in terms of how trade protectionism may affect economy, financial stability, and also your fiscal positions. Do you want to shed more light on that as well?
Whomever I spoke to last 2 days, it's either my dear colleague, Minister Shimshek, it's the head of UAE Capital Markets Authority, Mr. Alawadi. Whoever I talk to, we agree, not 90%, we agree on 100% what should be done and what we should do. I mean, we cannot affect everybody in the world, but let's do what we know that has to be done. It's in business, things seem simple. You know, in order the business to flourish, both parties or all the parties have to be, you know, happy, successful. And it's not that different in politics. You know, the abuse of one side or the other one, another, won't bring any success. Every crisis is an opportunity. We all know that this. And I think this crisis we face today, it's an enormous opportunity to build bridges among Europe, Asia, rest of the world. And of course, in order to be able to build bridges, and I agree, Europe has been particularly slow on this, we have to understand each other. I try to understand China, I try to understand other partners as well. My ambassador in China tells me all the time, every time I'm here, what is important. There are certain things that are important for Europe. Well, it's not a secret. One big thing in order to gain Europe's trust, it's called Ukraine. This is a big, painful point for Europe. It's absolutely unacceptable to have war in the middle of Europe when one country invades another. And, you know, in 21st century, that's just no-go. And this is something where Europe expects the rest of the world to support Europe. But, so, in order to build bridges, but then going back, I said at the beginning, everybody has to do her or his own homework. So, I'm coming from a small country, but nevertheless, we were not sleepy. You know, for example, it's a young country. We gained independence in 1991. But I'll just speak a little bit about the perspective from me as a Minister of Finance or my ministry. We have probably the most advanced treasury in the Central Eastern Europe, very progressive, working on, you know, new, very innovative instruments. We entered US bond market in 2012. And then during my mandate, we entered Japanese market in 2024. Last year, we issued the second samurai bond. This afternoon, I'm traveling to Tokyo because tomorrow we are organizing the second consecutive Japan-Slovenia Financial Conference, which is actually kind of a result of our work on Japanese market. And in next few months, well, better weeks, we plan to issue our first panda bond. And I know that you know why, I mean, what's the rationale behind? There's many reasons. But one of them, which is not seen at first, is actually building relations. And I'm sure that, as in Japan, this will bring to much, much closer cooperation between Slovenia and China, for example. And just to conclude, I don't want to agree that we have to adopt the new world order. No, we will not accept it. And there's one area which responds, which is not politically affected, it's financial markets. Probably we all remember the shortest mandate of the British government, which was in 2022. I think they survived 44 days. What was the reason that they stepped down? You know, it was after these large-scale tax cuts and borrowings, of course, the financial markets responded. You know, it was the fierce response. You know, so in order, if we cooperate, if we do what you were talking, what the speakers before at the beginning of this conference said, just let's do this, all of us, and this will bring the results we want. Just stop to complain and act.
I think very well said. I think just be rational and be sane, and you will be duly rewarded, essentially. So just now, Mr. Mehmet, you mentioned the trade situation, and in particular, the emphasis on service trade. I think Hong Kong is uniquely best positioned to do that, because more than 90% of the economy is service-oriented. But at the same time, in response to your question about our own country, I think our Vice Premier, just now in Davos, also mentioned that we want to be both a factory for the world and a market for the world. And along those lines, I know you have been really a very strong advocate for fiscal discipline, which is very much in line with what we have been doing, fiscal soundness in our basic law. But at the same time, I'm sure that apart from war, just Clement mentioned, and other key word that we always see now is debt. So you have been overseeing both the economy side and also the Ministry of Finance side, which potentially sometimes may be conflicting. So, but seems Turkey have been emerging rather well under your leadership. So in that context, any advice to the national governments or even generally to some countries which want to issue more debt in terms of how we should put our own house in order?
Well, thank you. 3.4 billion people around the world, live in countries where interest on debt exceed spending on education and healthcare combined. That's a catastrophe for, obviously, those countries where you have to spend more on interest servicing. I think the best way is to, obviously, in particular in emerging markets, in developing countries, there is typically a very large informal economic activity. So combating shadow economy should be key. And in today's world, it should be relatively easy because you can deploy algorithms, AI, all economic activity leaves some digital footprint. So that's number one. Number two, typically resources are limited. So prioritizing productive investments, investing in infrastructure, for example, clearly investing in human capital, these are essential for development and creating more tax revenue. Again, it really starts at home. Even addressing the complications associated with relatively large trade gaps. We all know that trade is the engine of global growth, but it does create dislocations in certain industries, in certain geographies. But if you have a decent fiscal, sense, then you can deploy fiscal policy to address some of those dislocations. I think that's also essential. So fiscal is key, but unfortunately, if you look at globally, global total indebtedness to GDP is 311%, and in emerging markets is over 230%. So these are very large global indebtedness numbers. In Turkey, it's about 94%. We need to make sure that in times of uncertainty and relatively high cost of funding, relative high interest rates, that we really attain fiscal discipline. And fiscal discipline has to be prioritized, and that's the only way you get there. You can't really talk your way into it. You have to deliver fiscal consolidation and prioritization of productive spending.
Thank you, Mr. Mehmet. And listening to Madam Zhao's plan about your coming leadership in AIIB, as you know, AIIB is going to have a Hong Kong office here in Hong Kong very soon. And we are now working closely with your team to, on the details in terms of agreement and others. So what's your expectation in terms of what Hong Kong can do for you and the bank in furthering your grand plans, as you set out just now?
Well, I think I'm really get excited on the upcoming opening of our office in Hong Kong. But instead of saying that what I expect from Hong Kong, the first question I need to answer is what AIIB can do for Hong Kong. Because Hong Kong is also a very important member of AIIB, as well as important international financial center. So I think AIIB is in the position to support Hong Kong to further develop its role as the international financial center, as well as international center of technology innovation and also marine industry and development in other industries. So I really would like to exchange views and listen to the people and authorities in Hong Kong on what AIIB can do here and support all these potential developments in Hong Kong. But for me, I think there are a couple of areas. And first, that as a Hong Kong as a international financial center, of course, AIIB would need development financing. So resource mobilization is a very important area for us to cooperate. And secondly, I also said that MDBs need to be a catalyst for changes. That means AIIB also works on promoting technological innovation. I think this also resonates with the policy agenda of the Hong Kong SA authorities. And additional to this, I think we are also in the position to finance infrastructures in Hong Kong, including those digital infrastructure, which is the strategic infrastructure today. Thank you.
Thank you, Madam Zhang. And in fact, digital infrastructure is one of the things that we're working on by building this digital asset ecosystem over the past few years. And last but not least, just now, Scott, you really inspire us with a lot of confidence about how multilateralism may take us. And I think one of the key things you mentioned is about the climate agenda. It's something that is also very close to Hong Kong's agenda as well, because right now the government issuing green bonds. At the same time, we are the center for Asia for the issuance of green bonds, be it governments or corporates. Are there any particular things that you are contemplating to work with us? Because so far, we have issued and also collaborated with World Bank Group to issue 2 tranches of catastrophe bonds in Hong Kong, which is essentially insurance-linked securities against the risk of earthquake risk in Chile, and also drawing on regional and global capital to finance that. So I'm thinking in terms of going forward, apart from talking about the specific policy commitment for climate agenda, any particular initiatives that you find Hong Kong has a role and areas that we can work more closely with you?
Yes, thank you for the question. I think absolutely, and particularly in the sense that we are motivated on the financing side to ensure that our client countries have affordable solutions, recognizing the demands of this agenda in scale, but in particular that they need access to financing on terms that will work for them in terms of pursuing these investments. So thinking about the foundations of the relationship with bond issuance, I think there's a lot more to explore around thematic bonds and understanding how we can work together in mobilizing a much greater scale of financing across our regions, recognizing we're operating from a model that already offers attractive terms to our countries, but how do we continue to innovate on the financing side that we can actually pursue these investments, particularly in a timely way right now. So thank you.
Thank you. So I think we are just sharp on in terms of finishing this session. And as highlighted by Chief Executive, this coming year, the Chinese Year of the Horse. And I think there are a number of key attributes of being a horse: very quick, very agile. At the same time, things do change quickly. So what I feel is now really changed for the better in light of multilateralism, and in particular, all the positive feedback being shared by the national teams and the MDB teams. And so we look forward to see how Hong Kong can work closely with national governments, economies, and also MDBs alike to make a world better and also more productive, at the same time more inclusive for everyone. Thank you very much for listening. Thank you.
And thank you very much, Secretary Hui, for moderating that panel. And to all our panel speakers, could I ask you to stand and come to the front of the stage for a group photo, please? For our official photographer. Excellent. Thank you so much. Can we have another round of applause for our panel, please? Our next session, which is the presentation on the joint HKTDC and EY survey, will start in just about 5 minutes at 10:50. So please stay around for that. That will be an excellent presentation on the survey. In case you miss out on any sessions during the AFF and you want to revisit some of our panels, be sure to check out our videos on demand, which are on the AFF virtual event platform. They'll be up there from the 28th of January for a month. So you will be able to check the videos in case you can't attend a particular session. There are some refreshments available in the business lounge and various kiosks between hall 5C to 5E. If you are leaving the room, please remember to take all your personal belongings during the break and return your SI headsets. And also don't forget to visit our sponsors and partners at the Future Green Showcase and the InnoVenture Salon. But we will have our next presentation in just a few minutes. Ladies and gentlemen, welcome back. I hope you enjoyed that short break. Welcome back to the 19th Asian Financial Forum. And can I ask you to all kindly take your seats as the next session is just about to begin. As AFF's knowledge partner, EY is going to share with us their findings from a joint survey conducted by the Hong Kong Trade Development Council and EY on how business and financial leaders are navigating disruptions and the strategic value of Hong Kong while shaping the next phase of overseas expansion and capital allocation. Now I'm delighted to welcome Mr. Jack Chan, JP, EY China Chairman, Greater China Regional Managing Partner, to the stage to tell us all about the survey. Please welcome Mr. Jack Chan.
Good morning, everyone. EY has been the top knowledge partner of the Asian Financial Forum for the second year. This year, in collaboration with the Hong Kong Trade Development Council, we are pleased to present the findings of our survey titled From Disruption to Blueprint, Charting the Future of Global Growth. Our survey was conducted from December 8, 2025 to January 12, 2026. It gathered responses from corporate leaders and investors spanning diverse industries, including financial services, technology, manufacturing and industrial, consumer goods and retail, trade and logistics, and healthcare and life sciences. Over 66% of respondents are from organizations with over $1 billion market cap or assets under management. So these findings reflect how large enterprises are thinking about and planning for the future. Our research focused on three critical areas. First, new realities and strategic shifts. Second, global growth blueprint. And finally, Hong Kong's strategic value. The findings we will explore today aim to provide insights on three questions. Number one, how are business leaders and investors responding to waves of macro challenges? Number two, what are their critical priorities shaping the next phase of overseas expansion? And number three, how can Hong Kong elevate its role to a global strategy enabler? First theme is about mindset. Our survey shows that business leaders are not waiting for uncertainty to pass. They are reframing strategy to transform and closing execution gaps and prolong uncertainty. As we dive into the results, over 90% of executives expect high level of geopolitical and economic uncertainty to last longer than a year, and 62% expecting it to persist beyond 3 years. This finding aligns with EY's recent global CEO survey, where a majority of global CEOs state that they believe such instability will become a new norm. The high-performing enterprises are embedding resilience into strategy by design. They are assuming disruption in every major move and building contingency from day one. With that lens, the next question becomes, what should we watch and what should we act upon now? Our survey highlights 3 disruptions that demand constant attention and 3 transformations that must happen at speed and scale. First, technology disruption, AI, cybersecurity, and the urgent need to reskill workforces. These are not future risks. They are shaping competitive advantages today. Second, geopolitical decoupling, trade measures, export controls, and shifting alliances are rewriting the rules of global commerce. Third, slowing global economic growth. With recession risks looming, companies must prepare for volatile market demand and tighter capital resources. In response, 72% of executives are prioritizing digital transformation, including AI and automation, to boost productivity. 58% and 39% express priorities in business portfolio reshaping and supply chain diversification, respectively. While most see the call for action, around 60% of the companies voice they shall become more agile in responding to sudden macroeconomic change, prompting the need to dial up executive training investments to elevate management scenario and contingency planning abilities. Despite all the uncertainties we have discussed, enterprises' will to grow and go abroad is still strong, but the way they pursue growth is changing. To illustrate, around 80% of executives are targeting over 5% annual growth in the next 3 years. 40% are targeting over 10%. This is bold optimism in a time of uncertainty. Based on our discussion with the C-suite executives and survey findings, growth is increasingly overseas-led. 54% of companies plan to increase their share of overseas business, while only 7% plan to reduce it. Business leaders are reshaping their company's geographical portfolios, reallocating resources, and adopting new operating models to secure growth beyond home market. This is a trend that we see across our client base. So, which regions are the strategic focus for overseas expansion? Our survey shows that Asia Pacific remains the anchor, with 81% of executives ranking it as a top priority region for expansion. But leaders are diversifying. They are also tapping into Europe, the Middle East, Africa, and North Africa for a more balanced global footprint. The same is evident from EY's analysis on the latest deal statistics. China's overseas M&A deal value exceeded $40 billion in 2025, up significantly as compared with last year. Asia remained the hottest destination, with deal value accounting for around 35% of total. Europe and North America account for around 30% and 15% respectively. From a sector angle, consumer and retail and TMT, the two sectors lead the pack, each representing around 20% of the deal value. In fact, the major deals announced in 2025 are from these two sectors, including a Chinese e-commerce giant acquiring a European retail company and a well-known Chinese VC acquiring an Italian premier apparel bank. Next, let us look at the key challenges that enterprises are facing when expanding overseas. Over 60% of leaders cite political or regulatory uncertainty and compliance complexities as their company's biggest hurdle, ahead of localization challenges. This is also what EY observed when working with many executives. They find it challenging to get clarity on market entry approvals, sector-specific regulations, national security reviews, and data security rules, etc. This is no longer just a legal issue to global executives. It is a strategic risk that affects speed to market entry and capital deployment. As such, navigational expertise and ecosystem partnership are more valuable than ever. Evidently, our survey shows that 68% of leaders favor commercial partnerships, 51% plan M&A, and 38% will pursue joint ventures. Companies need partners to fill capability gaps, accelerate and de-risk market entries. They can provide regulatory clarity, compliance confidence, and on-the-ground intelligence across geographies. In today's environment, forming strategic partnerships is no longer just an option. It has become the essential route to secure global growth. Across industry, we see notable rise in successful partnerships being formed between Chinese enterprises and multinationals to combine strengths, such as technology and supply chain, to penetrate and win in complex markets. To give you a few examples, a global technology leader leveraged a strategic fund partnership to accelerate its expansion in Middle East region and diversify its global manufacturing footprint. A major e-commerce player adopts solution ecosystem partnership model to provide integrated cross-border solutions, particularly in the high-growth markets of Southeast Asia. A leading African manufacturer established an R&D center to drive open innovation partnerships, achieve deep local integration in smart technology, and become a trusted local brand in Europe. These examples show the blueprint in motion, global growth through collaboration. And that brings us to the role of Hong Kong. Where does it fit in the big picture? Our survey shows that Hong Kong is more than a connector. It can become a proactive growth orchestrator where capital, compliance, connectivity, and capability converge. Over 78% executives view Hong Kong either as a critical hub or important node that enables the Asia growth strategy. The executives agree that Hong Kong has a unique combination of strengths: financial market ecosystem, accessibility to the Chinese mainland, international legal and regulatory framework, global connectivity and professional services, as well as East meets West interface for business, talent, and culture. With these advantages, executives see Hong Kong offers more than connectivity. They also see value creation potential in originating opportunities, aligning regulatory pathways, mobilizing capitals and capabilities. The comments are strongly aligned with EY's recent thought leadership on how the city differentiates itself as a value-adding partner. As we conclude, let's step back and connect the dots. Executives have a clear consensus that prolonged uncertainty is the new baseline for global businesses. Global growth is a strategic mandate. Leaders are not retreating. They are rebalancing portfolios and building cross-border operating models. Hong Kong has a unique value-adding role. By evolving from a super connector to a protective growth orchestrator, it can become the trust hub where capital, compliance, connectivity, and capability converge. And the strategic imperatives for every leader in this room are: number one, design resilience into strategy, assume disruption, embedded contingency, and build agility from day one. Number two, act boldly on global growth, diversity beyond home markets, and use partnerships to accelerate entry and reduce execution risk. Number three, leverage Hong Kong, tap its financial depth, regulatory clarity, and connectivity to excel globally and across Asia's growth corridors. The next chapter of global growth will not be written by those who wait for stability. It will be shaped by those who plan for uncertainty, pursue opportunity with confidence, and partner smartly to make it happen. Hong Kong can be at the center of that story. Let us turn ambition to action by building strategies that endure, partnerships that accelerate, and an ecosystem that power innovation and resilience. The choices we make today will define the future and create lasting value for businesses, economies, and communities worldwide. This is our moment to lead. Let's chart the future of global growth and shape it with confidence together. With that, thank you.
Thank you. And thank you so much to Mr. Chan for sharing the insights from that survey. We will start in just a moment the plenary session 2, Charting the Future of Finance in Times of Uncertainty. And this session will feature insights from leading institutional investors, central bankers, and regulators from major economies. If you do have any questions for our speakers, you can scan the QR code, which is on the screen. It's also on the back of your badge, and select the Q&A tab to enter your questions and just click Submit. So let's start our plenary session 2. And please join me in welcoming the panel chair, Ms. Julia Leung, SBS JP, Chief Executive Officer, Security.
Very warm welcome to this panel on charting the future of finance in times of uncertainty. I'm hugely honored to be joined today by such a distinguished panel representing central banks, securities regulators, and financial industry. Now, let us look back in 2025, in the last year. Everything rally is the term most frequently used to describe global markets for 2025. Last year did seem to be a period of calm, continued stability, and growth for markets. First, the fallout from a trade tension have apparently more muted effect on global trade as we see de-escalation and tariff and pauses in the second half of 2025. Also, the sharp rise in geopolitical uncertainty, which the previous panel talked quite a lot about, did not seem to dampen the mood in the stock market, and which is seeing double-digit growth for stock markets worldwide. International stocks have grown, have the best return relative to the US market for 2 decades. For equities, the MSCI World Index returned 22% last year, with major markets in Asia Pacific and Europe hitting new highs. Hong Kong EX regained the world #1 position for IPO fundraising. Equities aside, asset prices witnessed broad-based rallies that encompassed both risk assets and safe haven assets, from bonds to alternatives like Bitcoin. Gold and silver made new highs in tandem, and we just see the gold price actually rising beyond $5,000 per ounce this morning. For global economic growth, IMF has increased the global forecast to 3.3% this year. So we should ask ourselves, is this all too good to be true? Can this appearance of buoyancy be deceiving? The exuberance last year may give us all the impression that the global economy is resilient against the erosion of a rule-based international order. But if you look closer, there are several several factors at play which actually offsets the impact of global fragmentation. And they are, first, fiscal expansion by major economies. Governments around the world follow the expansionary policy to stimulate consumption, finance infrastructure, and increase social security and defense budget. Second, the continuation of rate cuts. The US Fed brought borrowing costs to the lowest level since 2022 through several cuts in 25. Benchmark rates now hover around 3.5 to 3.75%. And third, the most talked about is a wave of AI investment boom related to database and data centers and other things, underpin a rosy economic outlook, which is a key propellant for not only for the US, but for other markets. Technology and communication accounted for the bulk of market gains last year. Now, but the trends of 2025 may have temporarily masked the fundamental structural shift and fragility that could manifest themselves more powerfully this year. Now, the fiscal expansion has intensified concerns for the high debt level, and the AI boom exacerbates fears of an asset price correction, and also the uptick in inflation may limit the room for further rate cuts. So, with a generally smooth 2025 behind us, the new year of 26 has unfolded fresh tensions in Latin America to Middle East to Europe. The on and off international trade war is just flared up again. In addition, central bank independence has for decades served as an important anchor for international monetary order, is coming under threat. Therefore, the transition from what seems to be a stability to a more unsettled environment underscores the importance for investors and policymakers to remain vigilant and adaptive in face of evolving global dynamics. And only dialogue like this and collaboration can sail us through these uncharted waters. So without further ado, I'd like to hear from our panel what they think of this future of finance. There will be 3 rounds of sessions, roughly divided. The first one will be on the macro outlook. Let me start with the 2 central bankers. In your view, looking into the macro environment, what has changed and what has remained unchanged, and what will 2026 bring, in particular, concerning monetary and financial stability? Would Burkhard start, and then Governor Rhee?
Well, thank you, Julia, and it's good to be back here in Asia's World City for the Asian Financial Forum. So you have asked what has changed. All in all, I would say the macro-financial environment deteriorated markedly over the course of 2025, particularly against the backdrop of increased geopolitical uncertainty. You have already mentioned that, and then with the related risks. Trade tensions, the use of tariffs and sanctions, and also the risk of economic fragmentation have risen significantly, and we are seeing more and more fragmented trade and to some also extent financial flows. For an open economy like ours in Germany, this has weighed on exports and also the business confidence. And after a long period of very low interest rates in the Eurozone, we are now in an environment where financing conditions are structurally tighter than in the pre-pandemic decade. And at the same time, public debt levels in many advanced economies are also on the rise, posing here risks to this financial stability. In Germany, expansionary fiscal policy, including higher spending on defense and infrastructure especially, supports demand, but it also means that credible medium-term fiscal frameworks remain essential. And at the same time, I would like to say some fundamentals have not changed. Central banks remain firmly committed to their price stability mandates, well, as the Bundesbank have always done in the past. But in the euro area, the inflation has fallen markedly and is projected to be close to 2% over the medium term, even though the last mile may be bumpy. Also, the banking system in the euro area has proven resilient through several episodes of stress in the recent years, thanks to regulatory and also supervisory reforms implemented in the aftermath of the 2008 financial crisis. And then for 2026, I would be rather cautious, let me say so, about precise forecasts, given the exceptionally high level of uncertainty due to conditions changing frequently, and the risk of renewed trade conflict is violent, increasing the likelihood of adverse scenarios for economic growth and financial stability, and at the same time geopolitical tensions are increasing the danger of hybrid threats and thus also of cyber attacks. These could directly jeopardize financial stability, and I would conclude with that.
Thank you. Chong Yong, would you agree? Be cautious.
Okay. Julia, thanks very much. It's my first time in Asian Financial Forum, and I'm honored. Let me say three things for what remains unchanged and what will change from a global perspective, not just for Korea's perspective. As for what remains unchanged, I think first, global growth will remain mediocre, around 3.3% both in 2025 and 2026, according to the IMF, with relatively stable inflation, but very high cost of living due to the past accumulated inflation rate, and that has an implication for the more political tension everywhere. And second, I think geopolitical risk remains. We remember the last April, the Liberation Day, the shock that we have observed. And after that, we thought the things could only improve, but actually it didn't. And now you look at what's happening in the world, in Venezuela, Greenland, and Iran. I think geopolitical risk will remain for a while. The third thing is that the debate surrounding the AI will continue, whether this is about the impact of productivity on labor market or its implication for the elevated stock prices, especially AI-related stock prices. The debate will continue. As for those three things that I think will change this year, the first is monetary policy divergence has become more pronounced. Japan already started to increase interest rate. We are expecting U.S. will cut the rate anyway. And then many countries have now started to adopt its own monetary policy more. It has an implication for the interest rate and FX volatility, as we see last Friday, that you see the yen and the dollar movement. So this will continue. The second thing what will change is fiscal sustainability and the issue of the status of the government debt as a safe asset will be challenged. And the high deficit all around the world, it's not just the United States, even including Europe. This high deficit will question the sustainability. And also the more and more non-bank institutions, especially hedge fund, is now playing an important, enlarged role in government bond repo markets. And if there is a shock, we don't know how they will behave, different from the bank. So it has a very important financial stability implication. The third is potential for the asset price correction, in my opinion, has grown. It's very hard to predict how the stock price will go, especially AI related. But, we know that everything cannot continue to go forever. So sometime it's going to be a correction. And now there's an issue of, it's not just the stock prices. Credit spread has been historically low. and there are a lot of virtual assets, stable coins, gold, minerals, So I think at this moment in time, I think that the debates about the modernization of the regulation or the simplification of regulation will make the things more complex. So overall, I think this year, what I'm afraid is that the financial stability concern may place a more constraint on monetary and fiscal policy for many countries. Let me stop here.
Thank you, Chang Yong. I think both central bankers have painted a picture of elevated risk for financial stability as well as the outlook for interest rates. And I have to turn to a banker to look for if you were an investor. So you look at all these pictures. Last year seems that everything goes up in one direction. But how about this year? Do we see the kind of diversification that we seeing capital flows going to this part of the world? Would that continue? Would the asset allocation be different this year?
Thank you, Julia. At the risk of being a little bit contrarian, I'm going to be a little more positive. It's partly my job, but partly the way we feel. I'd say three things. One, if you think about the largest economy in the world and the largest capital market in the world, the U.S., we've got a fairly robust growth environment in the U.S. The third quarter was actually an outperforming quarter. We think the fourth quarter is going to be a good quarter. And then 2026, both from a macro and a micro perspective, and I'll explain that in a second, we feel quite good about. We have not seen against the back, and there's risks associated with this, but we have not seen against the backdrop of reasonable growth a combination of accommodative fiscal, accommodative monetary, and the entire deregulation overlay come together, which means that at least in the near to medium term, growth remains supported. Now, this has, as you know, both of my colleagues on the panel have spoken about, attendant risks associated with fiscal, and that is an issue. But I think one of the reasons why you're seeing reasonably robust markets is that the near to medium term environment, certainly as it relates to growth in the economy and earnings growth, continues to remain a pretty productive one. Outside of the U.S., there's idiosyncratic thematics that have driven markets. I mean, we've spoken about Korea earlier and the incredible performance of the market in Korea. I mean, that is a second derivative of everything that's happening in the technology world and the amount of infrastructure spend that's going in. Taiwan is not that different. In China, there's thematics around AI, industrial automation, biotech that are actually driving the markets. If you think about the economy in China, the overall economy is slow because there's overhangs associated with real estate, etc. But there's verticals that are actually driving investment, innovation, that are attracting capital to this part of the world, and in China in particular. So what I would say is, yes, there will be some diversification, but the reality is that there's approximately 70 trillion of global assets, of global capital that's invested in the United States. That number was a little over 60 at the beginning of last year. So that number hasn't gone down, it's gone up. The pace at which it's going up may slow down, and there will be diversification, but there's not that many markets around the world that have the scale to absorb that kind of capital. Japan does to an extent, China does, but there's capital controls. Europe does, but again, it's not as big as the United States market is. So I do think there will be diversification, both geographically, but also into asset classes, and we've seen how commodities have performed, gold, silver in particular you referred to, and that will continue to happen. But as long as the macro environment and the micro environment in the US and idiosyncratic stories globally play out, I think the markets are concerned about geopolitical. I think the markets are very concerned about the fiscal, as was spoken about. But the here and now seems reasonably good.
Thank you. So, Wally, you have heard from the optimist here. U.S. market is going to go from strength to strength. So how about Middle East, UAE? You are rapidly developing. You've heard the speaker said it's fermented. Everybody's trying to attract capital. So how do you position yourselves in this? There are more opportunities than risks, I'm sure. So how do you position the Middle East and UAE in all this geopolitical environment?
Thank you, Julia. It's good to be here again. Well, I'll add to the optimism that my colleague had. It's very rare to find an optimist regulator as well. And that's a reflection of the ecosystem that we live in the United Arab Emirates. We literally raise by being resilient and agile as well as government. Geopolitics is not a Middle East issue only. It's a global issue. Yeah? Let's look at it from policymakers' perspective. When there is always geopolitics, there is increase of regulatory fragmentation and arbitrage globally. And this is what we did in Capital Market Authority when we reform, and good regulators, I'm sure my colleagues here will agree, always reform their policies and upgrade their policies. When we reformed our new policy that was introduced a few weeks ago to the market, we made sure that we complement other financial centers. We made sure that the UAE continues to be at the top of the capital market attraction by having agile policies, agile regulations that is compatible to financial center destinations. Today, every single asset class that we have in capital market have grown between double to 3 digits. It's a great era that businesses are living in today. Now, is this sustainable? And this is the $1 billion question. And the role of the financial service regulator is to create that sustainability, to ensure that the policies, the regulations, the frameworks that they put designs a good foundational ecosystem that would be resilient when there is turbulences. We have witnessed, as experienced regulators, turbulences always happen to economies. But always good regulators would always reform and upgrade and update their ecosystem. Now, building bilateral agreements, bilateral relationship with counterparties as regulators, we saw it's a great economy scale. We needed to find out how we scale up the economy. The best thing to do, we found out, is building bilateral agreements. I started with yourself in Hong Kong last year. We signed the first of its kind mutual recognition of funds. And we started seeing great inflow between the two nations. We are signing tomorrow another agreement that hopefully will be a disruptive agreement to the ecosystem. And this is how we are as a country. We always embrace disruption in economy. We export good legislations as well. I'll end with that.
Thank you, Wally. So your formula to success is be resilient and build new relations. So that's why that's a good way. I think this is also part of Hong Kong too, being the super connector. Now let me turn to Ben, commercial banker and also very leading in this part of the world. So Ben, how does Hong Kong position itself in this new era of shifting relationship and shifting capital flows?
Yeah, thank you, Julia. First of all, let me build on what the other panelists have been saying, because I would probably use the term easy calm to describe 2026. I do agree that the world is filled with elevated risks, but equally, the world has been remarkably resilient. I think the commercial sector, the investors, have been very, very nimble and agile in adapting and adjusting last year. I think more of this will continue. Now, last year's, I think the policy volatility, uncertainty, has certainly drove investors to reflect on two things. One is around what is the world's risk-free rate or risk-free instrument. Number two, I do think investors are starting to reflect a little bit around their portfolio composition and whether they are over-allocated or under-allocated in different parts of the equation, okay? And this is exactly the type of position and context Hong Kong needs to take heed of and grasp in terms of opportunity. I do think there are three areas. One, I want to build on Julia and Gokul, your comment around diversification. okay? Because I do think diversification come in a multiple set of dimensions. Number one is really from DM versus EM, developed market versus emerging markets. I do think the world is currently very overweight in developed markets, in particular in the US, and I think there's some reflection about whether the underweight position needs to be adjusted. On the one hand, I agree, Gokul, with your comment. US is seriously big, and therefore it remains dominant. However, at, let's say, round numbers, 65% of global assets being allocated to the US, even if that means going to 63, 62, 60, it means a huge pool for the rest of the world to share. The question is, what is Hong Kong's position in this regard? Now, diversification also means another context, which is around China. China equally is going through a process of diversification by reallocating many of the onshore domestic allocation towards global. Okay, so this is also a time, an opportunity where Hong Kong's role can be played up. Then you're also talking about currency and different asset classes, all the way from treasury to gold to commodities to different, instruments. And in last year, if you look at the second half versus first half, we have seen significant increase in the issuance of, on the one hand, dim sum bond, which is foreign institution issuing in RMB, and also in a phenomenon called one-ton bond, which is foreign institution issuing in Hong Kong dollar. Fantastic second half. Why? Because investors are starting to think about diversification. Now that's one bucket. Second bucket, I do think, is in the continual rise in new economy industries and their thirst for capital. And Hong Kong needs to be in a top position to vie for that. And I think in the last so many years, Hong Kong has done a huge amount of work around adapting its listing rules, changing its weighting voting rights, changing its, I would say, appeal to biotech and pre-revenue R&D heavy companies, and I think Hong Kong needs to continue to do that. The last component, I do think, is as trade finance, supply chains are being rewired from what was a very China-led, now going via the global south, diversified before it hits the west, those trade corridors will increasingly be denominated in RMB. And when you have that, there's a need for investments, then there's a need for hedging, and Hong Kong plays a very important role in the risk management place in RMB. So these are some of the areas that I do think is prime for Hong Kong to grasp.
Thank you. Now let's move on to a second topic, which is the digital era transformation. Now last year, I think we've all been shocked and awed by the potency of the generative AI markets. And the stock market has been dazzled by all sorts of investments, like trillion-dollar investments by these AI companies. Now, I think later part of last year, we have a new realism crept in. And as in those of us in Hong Kong, including regulators here, we have piloted several things. So in this panel, I would like to explore the several new topics like stablecoin, digital fiat currencies, and AI application. I'll start with Wally. Your democratic change has actually brought new investment trends, such as higher risk tolerance, prioritizing speed, information through hearsay, social media, accessibility, as well as new challenges. So UAE has a very young population. I looked up, it's like the average age, the median age is 31. So what's your observation of investment behavior? And when you are building up your capital market, what is your approach to supervising them?
Well, very good question. Just as a disclosure, I'm not 31. I'm still way above that. But
some say you look like 31.
Thank you. Well, technically, we have seen globally a paradigm shift from that age bucket investment behavior, where the way how we used to invest, we used to go to professional economists and read proper analysis. Today, a specific generation, they use completely different methods to invest their money or to allocate their money as well. Now, what we did in Capital Market Authority, multiple things. One, I'll start with the technical one. We launched our extensive digital asset and digital asset service provider framework that's complied to IOSCO standards and all international standards, and hopefully it will be a legislation that many other jurisdictions can refer to. Two, because of that behavioral shift, if you recall, IOSCO had an issue when it comes to finfluencers. And what we did, instead of punishing the finfluencer, we launched an opposite campaign where, because of that age bucket, we launched a license called a finfluencer license. And what we did, literally in day one, we recruited or onboarded 100 applicants. And we looked at them very closely to see what impact those applicants will have in the society. We saw a great shift in financial inclusion. We were wondering where this shift came from. Yeah? Everybody started getting more educated in the sophisticated instruments and financial services. And we realized the finfluencers that we licensed, they played a very crucial role in educating the market. Yeah? And then they divided themselves into experts in commodities, experts in investments, experts in all type of financial instruments, which led, for us, for example, I cut my financial inclusion budget, yeah, almost to zero. My Undersecretary Ministry of Finance is sitting in front of me. I hope he doesn't remove it from my accounts. But why we did it? Because we saw these influencers are playing much important role, a much simpler role as well than us as regulators. The message that we delivered, apparently in a very complex way to the consumer, the influencers have delivered it in a much simpler way. And we have seen a huge surge in these applications, and we started training these influencers. And this is one of the one type of behaviors that we are changing. Now, we have seen a great shift in tokenization, yeah, especially in the United Arab Emirates. We started rolling out a new tokenization regime that allows instruments to be tokenized. And literally, real estate is one of the key fundamentals that investors want to tokenize. So that we are launching very soon, but we are monitoring it with data. Payments is one of the important things that's happening. It used to take 5 days in digital payments to be cleared out. Today, it's within a minute. Our Ministry of Finance started one of the first payment processes across borders that I think it was one of the first of its kind globally.
Thank you. Thank you. For Chang Yong, Blackpink is in Hong Kong. It was a real sensation. Yes. And also your investing public is also onto all sorts of new things. I was told that cryptocurrency has become a primary investment asset in Korea, and with investor numbers rising to 10 million. Stablecoins are increasingly positioned, and you also have tokenized deposits. As a central banker, we certainly are concerned about the monetary sovereignty issues, the systemic risk, and the consumer trust associated with stablecoins. So what is happening in Korea, which is, I'm sure, is just like Blackpink, will be a sensation in the rest, ripple through the rest of Asia Pacific?
Julia, I don't think you are expecting my remark is actually as exciting as Blackpink, right? So I don't want to make sure that it's too high bar. So, but as Blackpink show demonstrate, we are aging society, but our mind is very young. So that's why our tokenization and all this digital financing is growing in Korea. So let me explain Bank of Korea's perspective, what is our strategy to prepare for the digital economy. From our point of view, to prepare for the digital economy and tokenized economy, it's very important to make money programmable. So that was a key point. So we have thought about how we're going to introduce this programmability function into the money. There are many ways of doing it. The first one is definitely retail CBDC, but we found that with a very highly developed fast payment system in Korea, we don't see that the retail CBDC has many advantages. And at the same time, if we just introduce the wholesale CBDC together with the tokenized deposit, we can still introduce the programmability relatively easy without going to the retail CBDC. So that was a kind of our approach in the past 2 years. So we did many pilots to launch the tokenized deposit together with the wholesale CBDC to preserve two-tier system. Then the stablecoin discussion coming in because of the Genius Act, dollar stablecoin become more popular. And then our private sector insists that we have to allow Korean won denominated stablecoins in the market. Our view is that because the very well-developed past payment system, even if we introduce one denominated stablecoin, we are not expecting that this will be widely used for the domestic payment, especially if you have a tokenized deposit already with that. But there is a potential that the Korean won denominated stablecoin can be used widely if we developed our virtual asset market. In that regard, Korea has a very strange regulation. In the past, we didn't allow the issuance of a Korean domestic company to issue our virtual assets because we are worried about a lot of negative things. But given the pressure from the market, we allow the Korean domestic people invest on foreign issued virtual asset. So that is why, as you mentioned, so many people invest in a Korea exchange to trade foreign issued virtual asset. Now our financial regulators are thinking about to change that policy. So now they are thinking about the new registration to allow domestic institutions to issue the virtual asset. So with that legislation and with the more tokenized assets, tokenized securities, I can see that there is some use of the Korean won denominated stable coin. But still the debate is whether if it's just for the domestic use, whether the tokenized deposit can compete or replace that function. So overall, in my opinion, that Korea won denominated stable coin will be used for mostly cross-border transactions, while the Korea tokenized deposit will be used for more domestic payment side with the programmability. But that brings one unique issue, which is unique to Korea, because we still have capital flow management measures. So what we are worrying about as a regulator, we are, as you can see from our discussion, central banks are being paid to worry about many things. So what we are worrying about is that if we introduce Korean won denominated stable coins for the time being, whether it can be used to circumvent our capital flow management measures, especially combined with the dollar stable coin. So dollar stable coin is very much widely used. Now people can access very easily to dollar stable coins. So the transaction cost of using dollar stable coins compared to the actual dollar is much lower. So whenever the exchange rate movement expectation comes in, people rush to the dollar stable coin and do a lot of cash movement. Especially if you look at the regulation, what we are worrying about is that, for example, Tether is not a bank. And there are a lot of non-bank institutions to issue the stable coins. In that case, for us, it will be very hard to impose KYC or the ARM regulation. And then the fact that the lion's share of the use of the Tether come from Asia and Middle East means something. It's not used for the U.S. domestic usages, but more cross-border, probably to hide the identity for the foreign transactions. So our big concern at this moment is, yes, we need to somehow allow the issuance of the Korean won denominated stable coin, but whether it's going to be used for productive usages or whether it's going to be used mostly to circumvent our capital flow measures, that was an issue. So from a banker point of view, we want to have a more conservative approach. We want to allow the Korean won denominated stable coin, but let's start with issuance by the bank consortium or bank-led institutions. But the market cries that the non-bank has to be allowed to be allowed. But this is a political issue at this moment. Let me stop here.
Thank you. Thank you. I think you have brought out something that we're giving a lot of thoughts to from a Hong Kong regulator perspective. The stablecoin, and then versus wholesale CBDC and retail CBDC, and how do they intertwine each other? How does it play out, whether it's domestic or cross-border? So I would like Burkhard to add to that debate, since Bundesbank in Europe is thinking and probably very close to agreeing issuing the digital fiat currency.
Well, of course, we are very hard pushing towards own digital currency in a wholesale version, also in a retail version. So both is very important for us from a European perspective, and I do expect in the now ongoing year 2026, the first solution also on wholesale CBDC, so digital euro for wholesale CBDC. On the retail side, the digital euro would be developed as a digital form of cash, as we say it in Europe, for everyday payments in the euro area, whether buying bread, shopping online, or sending money to friends. So a real private solution. All of our 350 million citizens in the euro area would be then allowed and could use the digital euro anytime and anywhere. At the end, I would say it's a true all-in-one payment solution. While it will complement it, this is key in Europe because of also the political discussions, not replace cash. The digital euro would be managed by the euro system. That means the ECB and the national central banks of the euro area. And then we will, of course, establish a unified European infrastructure. The people should have access to the digital euro and also use it through their usual banks and the permanent service providers, making payments with the digital euro easy and familiar as payments are already today. Its development is driven by, I would say, three principal reasons. First, to ensure that central bank money remains available and also usable in a more and more digitalized economy, preserving its anchor role and supporting trust in our currency, the euro. And then second, to enhance the efficiency and the resilience of the European payments landscapes, where a truly pan-European digital solution for point of sale, online or peer-to-peer is still missing. We have national schemes, obviously, but not for the entire Eurozone. That means for 21 countries which are in the common Eurozone. And then third, of course, now it's getting more and more important, just looking around the other fellow panelists, to strengthen European and Europe's digital and financial sovereignty by reducing the dependence on non-European payment providers. Today, the European payment landscape is still heavily reliant on non-European providers, especially from the US, but also from other countries. But at the end, there's a heavily dependent payment landscape in Europe. The euro system would provide the core infrastructure and the rulebook, while banks and payment service providers in the euro area would distribute then the digital euro and offer the customer-facing services. And this would, at the end, combine public money and infrastructure with private sector innovation and customer interfacing. And then, of course, there's this big issue, as we are here in Hong Kong debating new forms of payments, also on the interoperability with other payment schemes, especially then with other CBDCs around the globe. In my view, we have here a historic opportunity to vastly improve cross-border payments by ensuring such an interoperability with other digital central bank currencies or other means of payment. However, I would have to admit in the upcoming time, our clear focus from a European perspective is really to support the legislative process for a digital euro and then prepare for its introduction in the euro area. But we stand very much open also to speak about and to save the interoperability with other regions and other currencies, digital currencies all around the globe.
Thank you. Now, for the two bankers, you've heard from the regulators from different regions. They are all planning some either as a digital stablecoin or digital fiat currencies. And then we all talk about tokenization, which tokenization of real world assets. We in Hong Kong have a lot of green bond digitalized money market funds and so on and so forth. The question for the bankers is how involved, it's a lot of payment platforms, and how involved will the development, if you're not in it, you might be cannibalized by it or disrupted by it. So my question to Ben first and then to Guogo is that how to prepare yourself to be part of it.
Yeah. Governor Ree first. I did go to see Blackpink last night. And sadly, I managed to pull up the average age at the Kai Tak Stadium, so that's a bit of an embarrassing thing. But back to your point, Julia, I think as bankers, we absolutely have to embrace it, otherwise we'll be displaced by it. Because digitization is moving at such a fast pace that will be transformative for the banking sector and the broader financial community. Because we are dealing with the digitization of money, okay, which is fundamentally transmitting from what was a very, very fiat-led world to a tokenized world. That shift is very, very transformative. Now, obviously, the ecosystem is very, very broad, as most of the speakers have talked about. If you look at the liability side, we're dealing with cryptocurrencies. We are dealing with stable coins. Then we're dealing with tokenized deposits, CBDC, which can be retail, can be wholesale, and we talk about multiple cross-border MCBDCs, multiple, right? So exactly how the market will evolve, which one of these will take off, we don't know yet. But fundamentally, as bankers, we also need to embrace all of them because ultimately, we want to make sure that we are plugged in. On the asset side, Julia talked about the whole world of tokenized real-world assets. We've seen a lot of activities happening. I mean, our bank did the first, I would say, Pan-Asia tokenized money market fund. There's ETF, there's commodities, and the whole spectrum of things. And I do think if we combine the two, we are dealing with a market that transitions towards 24/7, frictionless, and real time. With that also comes the need for crypto or digital custody, which is also very, very important. Because the lesson learned from FTX is if you buy, sell, trade, hold, custodize with the same institution or entity, that's where the risks lie. So we do need to find a mechanism to segregate to make sure that some of these assets are under good safekeeping. Okay, so that whole ecosystem evolving, and then you elevate yourself towards the entire world. We are seeing a very, very fragmented framework of across regulators. You have the U.S., which is really fundamentally, I would say, very conducive, free for all. We have other jurisdictions who are more conservative, and we have a third bucket which says over my dead body. And across Asia, I do think there's a role that Hong Kong plays in terms of taking that lead. I'm sure, Walid, you talked about UAE. I think Hong Kong is also in a good position. I mean, at FSCC, we keep on trying to come up with publications to make suggestions around what the market players are in need for. And really, to the regulators' credit, I mean, Julia, under your leadership, SFC, you have a very, very strong Aspire roadmap to look at how do you entertain the virtual asset, the VASP regime, and then from HKMA side, under Eddie's leadership, around tokenized deposits, Ensemble, Enbridge. And I do think these, again, will attract players to come and work with a transparent regulatory framework, and not just to play it, but also learn from it, because the world is moving so fast. We're all living and learning every day.
Yes, Gokul, do you agree?
Yeah, I mean, look, I think a lot's been said, Julia. I completely agree with Ben. I think we have no choice. I mean, you spoke about the demographics in the Middle East, but the reality is that even in more mature markets, the US or Japan, for instance, there is at this point, and we're big in the wealth management business in the US certainly, there's a generational transfer of wealth that's happening. And that transfer of wealth is happening to a demographic that will invest differently, invest in different assets, and digital is at the core of that. So I don't think we have a choice. How it'll eventually end up evolving, I think is still, it's early. But as it relates to building the infrastructure to be able to support the demand for that kind of product from a client base whose perspectives are changing, that's an inevitability.
Thanks. Now we move to the third and the last section where we talk about regulatory modernization. Chong-Yung, you started by saying that this adds complexity to the new, to this year. Now, regulatory modernization means different things to different people. In the US, which is led by the US, this term is actually deregulation. And deregulation is not a term the majority of the panel agree, but I'll start with Gokul because you embrace deregulation. So how does it, how would it affect bank capital and releasing it to the US economy?
I have to be careful here. I'm on a panel with 1, 2, 3, 4 regulators. So I will say right at the outset that...
and we have also other words rather than deregulation. And
I'd say we're big believers in financial stability and solvency. So let me start with that.
This is a disclaimer.
Yeah, but we spoke about the U.S. as an economy a little bit earlier, Julia, and one of the key planks of this administration going forward is deregulation. And within deregulation, one of the sectors that's squarely in the middle of that in a good way is financial services. And I think complexity is obviously a part of financial services, and I'm not minimizing the importance of complexity. But one of the things that we found and we welcomed is transparency. In terms of what we're supposed to do, how we're supposed to do it, and this is a very U.S. comment, but what we're supposed to do, how we're supposed to do it, and more interaction as opposed to unilateral behavior. With some of the changes that have taken place, and there's a whole bunch of changes, particularly as it relates to Basel III endgame, that are expected over the course of the next 12 months or so, just the large cap banks in the United States, based on what's happened right now, there's $125 billion of capital that's been released through stress capital buffers, SLR reform, et cetera, et cetera. If you translate that, you know, using sort of well-defined metrics, that's approximately $1.5 trillion of credit that becomes available to the economy. That's just the large cap banks. If you extrapolate that across the entire banking universe, those numbers are more than 2x that. And at a time where, and we spoke about AI and we spoke about the investment associated with AI, not all of that is necessarily going to be the appropriate allocation of capital, and there will be missteps along the way, but every time there's a technology that is revolutionary almost, that happens. I think the impact that that'll have on the U.S. economy, but frankly, a lot of these banks function globally, on the global economy is actually quite significant. So, look, we welcome it, but at the same time, I think there's a very healthy dialogue with the regulator about not abusing it.
Yes, I'm sure Bundesbank agreed that financial stability should come first. So what's your view? I mean, I think Andrew Bailey, the chair of financial stability, has called for global efforts to modernize and strengthen, but without compromising financial stability. So what is the course that ECB and
well, we fully share the objective of course, modernizing and strengthening financial regulation without compromising the stability factor, obviously. So regulatory modernization is not about rolling back the rules. It's about adapting the framework to new risks and technologies as AI and reducing unnecessary, of course, complexity. That's for us the most important thing. We want to preserve, of course, core safeguards that have made the system over the years more resilient. And in our own currency, so in the euro area, the reforms after the global financial crisis, in particular the Basel III standards you have mentioned, Gokul, and the common supervisory framework have significantly strengthened banks' capital and liquidity positions. And this stronger starting point, from my point of view, has proved its worth in recent episodes of stress. And at the same time, the prudential rule book, especially in the European Union, has become, well, to be very frank, it has become very complex. And I've been part of the lawmakers' process for almost 10 years, so I can really judge about that. And definitely that complexity can be a burden for banks and supervisors, and also can obscure which requirements are actually binding. But against this background, the European Central Bank, also the Bundesbank, and the other national central banks are working together here in a high-level task force on simplification. So we are already, of course, discussing how to simplify this very complex environment. The aim here is to streamline the framework, for example, in combining certain capital buffers or by introducing a certain regime for small, low-risk banks without lowering overall resilience. And of course, proportionality plays here a central role. Smaller, less complex institutions should not be subject to the same level of detail as the large and internationally active banks. So for me, for us, modernization also means closing regulatory gaps. When new risks emerge, important vulnerabilities lie outside the traditional banking sector. That's also very clear for me. And at the end, I would say international standards such as, again, Basel's Committee Framework for Banks' crypto asset exposures, and also you have mentioned Andrew Bailey, the FSB's work on the global crypto asset regulation are essential to avoid, at the end, regulatory arbitrage and to prevent a global race towards the bottom. This is not in the interest of central banks, and I would say on that we can also agree here at our panel.
Yes, no race to the bottom. Governor Rhee, you would agree it's not deregulation, but simplification and streamlining is the modernization.
Yeah, as Gokul mentioned, I think this simplification, deregulation, modernization will definitely has a positive impact on the real economy activity in the short term. But we have to remember what cost we have paid in 2008 too. So as a chair of the CGFS committee at Basel, I also echo this exercise should not be the race to the bottom. And if you ask what kind of impact it has in Asian area, it's interesting because Asia is very heterogeneous. And most of this discussion is about the G-SIBs, globally significantly important bank. And except Hong Kong, Singapore, China, and Japan, not many Asian countries are G-SIBs. So those four countries will have a direct impact on this discussion, but the others have a spillover from this discussion. And I can think about two spillovers at this moment. If you remember the Basel III, when we discussed the leverage ratio regulation, initially the credit conversion factor for the trade financing was about 100%. That has a large negative impact on the supply of the credit trade financing for many EMs. So luckily, initially it reduced to 20%. So problem was diminished. But I'm very curious what kind of discussion on this G-SIBs has on the trade financing issues for many other Asian countries. Second area that I think we need more regulation, not less, is about digital financing. And as we discuss about the risk of digital financing, these things is stable coin, whatever, especially dollar stable coins, because the many issuance of dollar stable coin was actually happened without existence of the proper regulation, and how we can deregulate them again, that will be a huge challenge to the U.S. regulators too. And then what I'm worried about is that with a lot of private bank, private non-bank issue stable coins, I'm afraid that we may see the same history coming back to this private banking area in the 19th centuries, and we see what kind of mistake we have made. So at least for the digital finance and this area, we need not deregulation, simplification, modernization. We need more regulation.
Because there existing no regulation, basically. So I think we need to build up regulation where it's needed, but it has to be streamlined. So I'll move to you, Wally. Given that you are rapidly building up and issuing regulations which are in line with international standards, but it seems that the other parts of the world are actually reducing those regulations. It seems to be a very fragmented world of regulation. So how do you make sure that you are connecting and consistent with the rest of the world?
True. Technically, Julia, if you see what's happening globally today, we are seeing and witnessing a huge shift and fast shift to the economy. Now, the economy that we see today architecturally might not exist in the upcoming years because of behaviors and the new complex financial instruments that have been introduced. Now, what we did in the Capital Market Authority, we changed our philosophy as regulators. One, we see things from different lenses completely. And harmonization, having closer dialogue bilaterally with our global counterparties and standard setters led us to design state-of-art regulations. We stayed away from competition and regulation because I agree, when we compete in financial services regulation, it becomes race to bottom. Yeah? We always like to maintain the highest standards of regulations. And this is where the government made sure that our legislation is a legislation that we could export and benchmark against globally. We started having global dialogues to make sure that we complement each other's regulatory standards. In IOSCO, there have been good launches to legislation that we used, but maintaining transparency and safeguarding investors is key. When it comes to digital assets and digital asset service providers, these are the two key risks that we have. And then being 100% compliant to AML is something that we don't want to not have an oversight of. This is in a nutshell what we are doing.
Yes. So Ben, from your perspective as chairman of the Financial Services Development Council, what is important? I mean, when you look at all the discussions about deregulation or simplification, what is your view? How to right-size deregulation?
I think other speakers have talked about the kind of deregulation, simplification, but I'll add to that, which is the importance of what Waleed said. It's around regulatory alignment and harmony, okay? Because the world, as you said, Julia, earlier, is increasingly fragmented. The worst case is regulations start to fragment, and with a fragmented regulation, investments will be fragmented. Okay. Now, obviously, there are tons of different standards. You talked about Basel rules, IOSCO rules, ESG, TCRD. You have IASB, IFRS, etc., etc. So a lot of alignment that's required across multiple platforms. The downside of what any financial sector not following would be A, investments will become increasingly home biased with discouraging cross-border investments, also therefore discouraging diversification. That's a bad thing. Second, as Burkhardt said, there will be race to the bottom, there will be regulatory arbitrage. That's very, very bad. And third, really to Gokul's point, you will have trapped capital, trapped liquidity, and increased costs of financing. That's not good either. So I do believe in a world, and Hong Kong needs to fit right into it, is an alignment across different jurisdictions' regulatory framework, because only with an aligned world can the capital markets be best supported.
Thank you. Now we have less than 2 minutes left. I can ask each of you a question about your wish for 2026. Only 2 words, 3 words, so I'll start with Wally.
Well, harmonization between regulators is key, and 2 things is a personal wish. I would like to have each of my staff to be an AI agent and to be able to build AI, and this is something I think we should talk about at some point in the future.
Okay,
thank you.
Okay, I'll leave here the wishes for the AI developments. I want to see still independent central banks all over the globe. First, secondly, of course, I want to really have less fragmentation in our world and more cooperation. And then lastly, that we will progress with our Digital Euro project.
Ben?
Calm prevails, sense prevails.
Gokul?
Less concentration. We spoke about capital flows, so global diversification based on global innovation.
And Chang Ho?
Unnecessary geopolitical uncertainty decline for the humankind being.
Thank you. Now, I think we agree that we are not Blackpink, but to the financial world, I think you are more or less the stars of like Blackpink. So let us give a round of applause to our distinguished speakers. Thank you very much for all of you.
And thank you very much to Julia Leung for moderating that. Can I ask all the panelists and Julia to come to the front of the stage for a group photo? Thank you very much. Ladies and gentlemen, while they're taking the photo, we would love to get your feedback. So if you don't mind just taking a moment to scan the QR code on the screen and share your thoughts on the AFF with us, we really appreciate all your valuable input. Coming up next, our exclusive keynote luncheon today will feature an impactful dialogue with Dr. Jose Manuel Barroso, former President of the European Commission, former Prime Minister of Portugal, Chairman of the Advisory Board at Goldman Sachs International. So if you are a full pass participant and you're going to that lunch, please go to the Grand Hall on level 3 now, as the luncheon will begin shortly. We have signage around the venue to help you get there, and our staff will also give you instructions on how to get to the venue. For our other attendees, there is a food concession area in Hall 5F, where you can enjoy your lunch and watch the live broadcast of the keynote luncheon. Please remember to leave your SI headsets if you use them on your seats, and do also take all your personal belongings with you, as anything left behind will be removed. We'll be back here for the panel discussion on the global economic outlook at 2:15 p.m. So 2:15 p.m., we will see you then, and enjoy your lunch.